Thank you, everyone, once again for joining us tonight for this Financial Literacy Thursday. My name is Margaret Businje, and I'm deeply committed to advancing financial literacy and helping our communities build lasting financial confidence. So tonight, we focus on a topic that speaks to long-term impact and generational vision, legacy creation, and asset growth strategies. This conversation goes beyond building wealth. It is about creating structure, protection, and intentional pathways that position families to thrive for a decade to come. We are honored tonight to be joined by an outstanding voice in this space, Mr. Herbert Diego. Herbert brings a valuable insight and practical expertise to help families to think more strategically about how we grow, protect, and transfer wealth with purpose. So tonight, we're going to open up a discussion. We encourage everyone to participate. Keep actually your mic for now. After this discussion, we'll ask you to open up and discuss with us. So without further ado, please join me in warmly welcoming our speaker, Mr. Herbert Diego. Diego, the floor is yours.
All right, thank you. Thank you, everyone. Appreciate the chance to be here tonight and talk to everyone as we share, as we learn and share with each other. It's always a pleasure to be on this Thursday talk. This is actually my fourth, I think fifth time being here, so I appreciate seeing everyone around. Thank you, Ima, for the invite and being part of the team. This is a team thing, and I appreciate the fact that we always keep going. It's a recurring thing. And as most of you saw on the flyer that was shared around for this week, we are meant to talk about legacy creation and asset growth strategies. Why is this really important? We should be able to delve into this much deeper as we are going to be sharing for the next 45 minutes from my timer here. Usually we block this hour every week of Thursday to talk about wealth creation, talk about generational wealth and asset growth. It is in that regard then I'm coming to you tonight and sharing. My name is Herbert Diego, as you can see on the screen. And I like to be, let me see, how do we set rules of this session? I like it to be very participatory, and if you can please share back when I ask, feel free to, open your mic up and share. And as a matter of fact, let's go ahead and get started here with a simple exercise. As you can see on my screen there, I have very famous quotes, and these are quotes of a lifetime. They are from famous books and characters. You may know, you may not know, but please, just to get us started here and to break the ice around the session and around knowing each other and what we know and don't know, let's go ahead and guess. I will just be sharing the quote, and then we give it about 5 seconds for someone to open the mic and say if they know about that. If you know, just say straight who said that quote or which book do you know of it. The first one here says, a good man leaves an inheritance to his children's children. Anyone ever heard about that? We'll just move on. The answer to that is one of the very famous books of a lifetime. It's called the Bible. Someone knows about the Bible or don't know about the Bible? I don't think anyone never heard about the Bible. That's the exact reference in the Bible if you want to look it up. In Proverbs there. Let's go to the second one. Someone is sitting in the shade today because someone planted a tree a long time ago. Ever heard of that? Or would you guess anyone that ever said that? This is, okay, let me give you a hint. This is a person. It's not a book. It's a person, a very famous person, actually. Someone want to guess? All right, 5 seconds. We'll just keep it tracking. This was said by Warren Buffett when he was talking about generational foresight. Let's see the third one. Wealth should outlive you and bless others. The man who dies rich dies disgraced. Who would guess the person that said this, or whose quote is this? What? What an audience tonight. Anyone want to guess? Oh, I see some chats in the box. Sounds like from the Bible. Okay. That's a good guess. Thank you, Layla. That's a really close guess. Yeah, it's more relevant to what the Bible says, but it's of course not the Bible, but it's really close to what the Bible said above, what we just saw in the first place.
Andrew Carnegie, I guess.
Andrew Carnegie, yes, you get it. There you go. Thank you. Thank you, Andrew Carnegie. One more test here. Actually, this one is going to be a $100 test. It's one last quote. There it is. What counts in life is not the mere fact that we have lived. It is what difference we made to the lives of others. Whoever gets this right takes away $100 tonight. Go ahead. You have 5 seconds. 1, 2.
Uh,
What? Nelson Mandela. Layla got it. Yes, in the chat.
right.
Nelson Mandela. What? Layla's here to make money for sure. Yes, yes. Nelson Mandela said that. Very good, very good. See me after the session for your $100. All right, let's go ahead and get started here. Planning for the future, self and generations. Why should you plan for the future? We have a beautiful image there. We can see a family. It's actually a generational family, if you can see. In this picture, we see, aged couple, their son or daughter, and son or daughter-in-law, and grandkids. Let's put it that way. Now, we are here to live, and if we can actually tag this whole talk from the previous quotes we just saw here, as you can see, all of these quotes are actually meant to share us one same thing. So I was saying, if we can tag this talk, that whatever we are going to share in this couple minutes to these quotes, these are lifetime quotes, if I may put it. Yes, they were put forward by mortal men, with the exception of the Bible. The Bible has been there for, a lifetime, if I may say. I mean, much of these guys, Warren Buffett, Andrew Carnegie, Nelson Mandela, and many, many others, they all pointed to the fact that we should live not for self, but to generations. And not just 1, 2 generations. Actually, if you can see, the Bible says, children's children, going forward and forward. We are here today because someone did make this place better. So that's in the same exact spirit that I'm bringing this slide and the next slides. If you can think of this guy, or think of yourself with your children and offspring that will follow on, it is very important that you do a great job of planning your estate or your future, or your assets. Let's say you've done a great job of planning your estate, and most of us haven't even. For those that haven't, you still, have a chance to give a shot on that. But now that you have planned your estate, you have planned your future, you're saving for your retirement, you're trying to do a savings account here and there. We know life is not easy. But then the call, the challenge is to do it not just for yourself. Do it for your children. You're going to live here, your children, your children's children. And that's the whole essence of living. And that's what it says, a good person. As a matter of fact, let me make it more strange. If you plan to have a legacy that stops on yourself, and you're planning for your savings, your retirement, you're not doing enough. And as a matter of fact, the court said you're not good. So if you're not good, then there's no in between, you're bad. I'm not here to call shots on who's good or bad, but the standard says we should plan for generations to come. Now you would think of your children, you would think of, what planning do they have? In that sense, you'll be doing great, you'll be doing better. And what if we could help you tonight or in these talks of Thursday's evening, here in such sessions, you get to learn on planning and creating a legacy that will go on to children's children's children, to people outside of your family tree, just like we're here, because there are people that did make this place better. That's the whole point that we talk about here. Now, let's look at this idea of MALT, generational legacy planning. And as you remember, we said tonight, we'll be discussing about asset growth strategies. How do we grow assets? What strategies that are there that we gotta learn and put in place a sustainable legacy that goes on and on and on. And that delves us into marrying our wealth, our assets, our properties, whatever we have, with someone else's health, with your child's health, with your children's health, with your grandkids' health. It's very possible to do that. We just have to learn what those strategies, and they're here, they're in this very economy that we operate in. It's just so that we don't know about them, or we gotta have those people that understand them to help us, tap into those strategies. Consider a quick example here. Let's say someone has 100,000 and does nothing. Maybe you have them on your bank or in another property somewhere. But let's count it as cash. Maybe you have an estate, you have a mortgage, you have a house that you paid off already, or you have this liquid cash seated somewhere in the bank. And you'll be lucky to find a bank or any financial entity that will pay you an interest, maybe of 3%. Let's keep it low, 3%. Let's keep it high, because as most of you know, banks, if you have money seated in the bank, they'll give you, maybe if it's 100,000, they might give you like a couple of, $5, $10, $15. But let's say for sure you have this money somewhere, and you're lucky to find somewhere they'll pay you interest, annual interest on this money, that they're going to keep it for you. Now, mental math. Open your mics, please. Again, I said this should be participatory. Open your mic. What's the 3% interest of 100,000? How much would that be?
3,000.
There you go. 3,000. Thank you. 3,000. So that is coming to you in return. That's called a gain that is going to be taxed by the IRS. As a matter of fact, we are in tax season, right? So that comes handy. So if you have somewhere 3,000 and a bank or any entity agreed to pay you 3% annual interest, they are going to report you to the IRS that we paid Mr. So-and-so, Madam So-and-so, $3,000 in interest. That goes on a 1090 what? I think it's a 1099 or 1098, 1090 something. It's a form that gets reported to the IRS. And the IRS comes after you for this 3,000, you have to pay interest. Now, can somebody guess how much of the tax charge is going to be on this 3,000? Because remember, it's a gain. It's going to be taxed. The tax rate. What's the rate here that will be charged by the IRS? Our Uncle Sam? It is going to be 35%. That comes out of the 3,000, not the 100,000. Remember, you were given 3,000 as interest of your 100,000 principal. So you get to pay a charge or a tax on that gain of 3,000. Now, if you take $3,000 and you pay a tax of 35, that's going to be $1,050. That's 35% of 3,000. That comes out, goes to Uncle Sam. Now you have the balance. How much is it? Help me here. Let's do mental math really quick. My mathematicians here. Help out, help out. How much is the next balance there? Or just
1950.
There you go, 1950. Thank you, 1950. So that's actually what you're earning. Now, remember, if you do 1950, this is actually what you actually gained. And you can use this 1950 maybe to invest, to pay for whatever. Maybe if you do 3, 4, 5 years, you have a couple thousand and maybe you buy something else. But this is a more traditional path. This is a more traditional way. And here we actually saying you're doing nothing. Literally, you just, give it to a bank or any entity. They give you this interest rate, whatever rate they agree. Some would say 1%, 2%, 3%. But whatever amount they give you, you call it a gain, you go buy insurance, you go buy property, you go buy any whatever. And that is a more traditional pathway that could even have been there could have been a better way. Now, let's say the other alternative would be planning indeed for a multi-generational study. Let's say maybe MLP here, it's a multi-generational legacy planning. Now you're thinking you have the same 100,000, but you want to plan. You want to think beyond yourself. You're thinking, you're looking ahead and trying to set up a legacy with the exact same situation, with the exact same amount of money, but we're going to see a different alternative that could actually be much better. Now, 100,000, you loan it, you give it as a loan to an ILT, an irrevocable life insurance trust. Now, I understand most people don't know about this, but that's why we're here to learn. An irrevocable life insurance trust. Think of it as another entity that is going to control that money for you. And with irrevocable trusts, you give it to, and you design someone else that is going to keep that money, that is going to take full control, not you. But then you stipulate how you want those 100,000 spread out in case you are no longer there. That's the whole idea. The idea of calling it irrevocable. Let me actually show you the idea. Let's study a little bit about the ILT. What is an irrevocable life insurance trust? Look at this. That's the explanation. Think of it as a special legal box, like some type of a box that is on the side that owns a life insurance policy. And that box is controlled by someone you choose, okay? So the money goes to your family tax efficiently and protected. So that 100,000 is going to be owned by this other entity, and you designate someone to control that box. And that box keeps the money, and in due time, if you loan it out for 20 years, let's say 20 years here. Maybe you can say 10 years or 30 years, whatever amount of time you want to give out. They're going to control that box, not you. The reason it's called irrevocable, look at that, irrevocable. It means you cannot easily go back and change the terms. But at least now in this case, we know for sure it's going to hold fixed for 20 years. And the whole other idea of irrevocable life insurance trusts is the fact that you cannot change it, but also the money will go as you stipulated, no taxes, and it's protected. It has to be exactly as you stated, Arion, before you let go of the ownership. Now let's keep going. Now you take about ahead these 20 years, you give the money, 100,000 to IRT, and the IRT is going to purchase a custom whole life or a life policy, let's call it a whole life policy. Some people will say term, some people will say, permanent, some people will say IUL, individual, whatever, but a life insurance policy on someone's life. Maybe say, in this case, let's be specific. You take a life on your kid. You say, okay, you, the trust, who's going to be controlling my 100,000, buy insurance on my kid's health. Now they go ahead and buy insurance, a life policy on your kid. Remember, you have 20 years to do this. That's what you're telling them. They buy it. They're controlling the funds. Instead of earning those interests that you were going to be earning back if you had given it to a bank or any other, those interests, you forego them to be paying those premiums, to be paying life premiums on your kid. Because at the end of the day, you know for sure you're going to keep back your 100,000 if you're thinking of it in terms of helping your children or helping your offsprings. It could be your children's children. Now, in case someone dies, that kid or whoever that your son or daughter, they don't just your estate, your family, your entity. You guys don't get just 100,000 back, but you're getting even a death benefit in addition to that. And the death benefit is spread out to the other dependents, the other beneficiaries. Remember, you designated the beneficiaries early on in the irrevocable life insurance trust. Now, in this case, you're buying a life policy on a kid, and those premiums go on. Now, there are many, many benefits we just saw there. Now you have back your money protected. You have the death benefit that is more likely to come on the protection of someone's life. You have a cash growth that comes from the protected life. The person insured's life have a cash growth, cash value. That's why we said custom whole life. This whole point of calling it custom whole life is meant to say you have a certain amount of time to pay those premiums. You're not going to pay premiums for a lifetime. It could be a whole life. It could be, you could even say a permanent. But I mentioned custom whole life here to reiterate the idea that you could pay these premiums for only 20 years. Because remember, you have 20 years to give the money back to the lender. And that's going to be yourself again. The trust has only 20 years. So they could make it exactly 20 years or 19 or 15 or whatever, but they customize it in terms of time. And the money goes back to the owner. The premiums are already paid up within that time frame. You're locked in on death benefit. You're locked in on growing cash. Your crazy things going on with this kind of strategy. I call them crazy like it's, mad ends. Not crazy in a bad way, but in an explosion of income streams. Now, this may be too much. This may be, a lot to understand here, but the whole point is you can't let your money just sit within traditional boxes. We got to, share it out. We got to find ways to invest it. But here, again, we actually see that the life policy, the life insurance protection, using whatever monies we have, could be an incredible ways if we actually structure them in more better ways. If structured correctly, you could activate several streams of income. Now, let's look at it in a more practical way. The ILT, or the Irrevocable Life Insurance Trust, is funded with the life policy. Now, after 20 years, I mean, I'm drawing this from this very example we just had here, because remember the loan was for 20 years. Now, within those 20 years, someone is texting in the, would this be compounding at 19%? Yes, no, compounding, compounding, we're not there. Don't look at the compounding yet. Compounding, that's actually going to create additional streams of income. If you bring in the ideas of compounding interest. But we're going to get to that piece yet. Let's say the ILT that we are looking at here, sorry. The ILT, the revocable trust now is funded with custom whole life insurance. The funds that are in there, after 20 years, the money goes back to mom and dad, or mom or dad alone, whoever gave out that money. If you are the one that did this in planning for your kids, after 20 years, the 100,000 comes back to you. And your kid grows to retirement because now they have this whole life policy on their life. Their retirement income is secured for your son or for your daughter, let's say, whoever you took the personal health for your revocable trust. Their retirement is secured. Yours is even more secured with the strategy you set up to get back your exact amount that you gave out. But we have to mention here that these policies usually accrue on interest at the current rate, and such loans or withdrawals will decrease the cash value. Now, the reason we have to make this point here is, remember, if now this person retires, they have a fund which is a cash value to draw income in for their retirement. Now, as you draw money out of this fund, it's going to reduce the growth and the balance in there. That's how it plays out. But then there's another aspect of death benefit that is locked in there, since the time for paying the premiums have already lapsed and you've paid your premiums in full. Now, at age 86, these are children's now. If, say, this person was to die along the way, the son in the first place was to die along the way, there's a death benefit that goes on here to the kids. Now, we have a first generation here that paid 100,000. We have the second generation, which is your son or your daughter or whoever that you could insure the life on. And then we have a third generation that could receive those benefits. And by doing this, you're not only lifting the burden of your children, but you're also locking in the legacy of their children, and at the same time giving them leeway for them to invest in others, to invest in other streams, or even do the same exact thing and plan for the fourth, fifth, seventh generation. That's how the Rockefeller's, the families that we hear nowadays, that are kind of mastering this, the Rockefeller Foundation, we have several families that have locked these things in, and we're drawing our lessons from practical experiences. Now, let's take one last, I see time is kind of flying by, but I want to come to one other quick aspect. Let's look at the multi-generational legacy planning versus the traditional ways, which I named here as doing nothing. We're just going into the traditional ways we have and, keep it, because we just saw two versions here. There's a do nothing version and there's a legacy planning version. The blue piece and what color is that? I don't know. The brown piece, let's say the chocolate piece. Now, if you keep the 100,000, we saw we would get 1950 after tax, and you could maybe use part of that as your retirement, and maybe you invest for others, another half. The $975 is exact half of the 1950. So if you were to earn, if the strategy was to, operate in a traditional way, you get, almost 2,000 here. You divide it by 2, which is nearly 10. You take piece of it to your self-planning and another piece of it to planning for your children. Yeah, it could work that way. Maybe, hard, but, I can see that happening. But let's look at the legacy planning path. You loan the money to a trust, and the trust buys life insurance, a policy on someone's life, practically your kid in this case. I mentioned a custom whole life, but then we get to give that money back on level 2 here. Goes back in 20 years. And you locked in the insurance for a lifetime. That's a strategy. Life insurance, the policy is locked for for the rest of the life of that person. But the loan amount, the principal goes back because you were using the 1500, let's assume on a more traditional way, the 1500. So for someone who asked about compounding at 19%, let's just keep 3%, which is a 1950. But in this case, it will be 3,000. Remember, because it's in the trust, there's no tax. In the trust, if this money is invested, you're not going to be taxed. Instead of paying those, interest back to the lender, you use those interests now to buy the policy, a life policy. By the time your kid or the person insured gets 71 or 70, whatever age of retirement it's going to be at that time, after maybe say whatever amount of years, 15, the cutoff in this case is 20 years. Now, they have a retirement. But if they don't retire, they keep working, all the better. Now, in case, because we know for sure at some point, 70, 20, whatever, 10 years, it could be 100 years of age, this person is going to die at some point because we're all living here to stay. Is that the case? No. At some point, someone is going to get going and move on to another chapter of life out of this life we have today. The legacy there becomes the death benefit goes to the kids, and so on and so forth. If you do the same thing as a person, you do it to your son, and your son does it to their children, that's how we come back to the initial idea of planning for generations. Now, let me take you back on this simple point. We're in the tax season, as we just mentioned. And most of our people, most of the folks in the marketplace today are doing their taxes. We're in tax return season. Already, some people are already, getting these. Some others are going to be getting these in the next couple of days. You get those refunds. If you're not lucky enough to be able to pay, you have to be paid. That's a grace that is coming back to you that should not be wasted. If you get a tax refund, it's so unfortunate to take those refunds and buy liabilities, if I may say. If you buy a car, maybe you put down a down payment of 10,000 or 5,000, and maybe the car is worth 20 or 30,000. You just purchased a liability. And depending on what use of that car, it could be an asset or in most cases a liability because you're going to be paying it after or the lifetime of that car. Now, instead of buying traditional assets or buying liabilities or wasting, let me say, I don't want to say waste it, because whatever you're doing it, maybe you want it. You don't need it, but you want it. Yes, I get it. The other strategy here could be investing a portion of that money, because remember, the whole idea of giving you that refund back is to tell you that you're not yet to the standards of proper living. So the only way you can get out of that is to invest. Investment is the vehicle of growing up your standards of living. Actually, as you saw from, I remember from my previous talk here, we were looking at two assets that push your standards of living. Two actually vehicles. One is assets, the other one is income. So with a refund from the government, as we're doing nowadays, that refund can give you both assets and income in one shot in purchasing a policy on your life or the life of your loved one, maybe your kid, your other, as long as you have an insurable interest in another person, you can buy a life on that person. Could be your mom, could be your niece, it could be. So that's the strategy that you can use to position refund. Let's say you get a refund of 5,000, and maybe you say 2,000 or 4,000 are going to be invested into this channel, and then you get to use your wants or other basic needs with the remaining balance of the refund that you receive. That the strategy right there is that you're going to be saved on the stresses of monthly payments and drawing these premium payments out of the monthly checks you're getting. And if you're unfortunate to find yourself between jobs, then you're going to be facing challenges of keeping up with those monthly premiums. So we are helping our folks, we're helping our audiences, we're helping people to redirect whatever portions of money they have to investments that will go long term. And if we take the current situation of tax refunds, would encourage, highly encourage people to use these refunds on annual payments, not monthly payments. So that way you get rid of these monthly draws on your bank account, monthly payments that you're not even sure if you're going to be having those monies for the next 12 months. So the refund gets redirected back. By the time you're due for another year, then you're on another refund. If you are good enough and lucky to be able to pay, because it's so unfortunate and interesting when people try to force themselves into the bucket of being paid the refunds. That's actually a negative thing, because you're actually not yet to the standards of living, the proper standards of living. It's literally another way to tell you that you should be actually doing better. That's the whole point of getting money back. If you're paying, it's not a bad thing as people get it from the outlook. You're blessing. Yes, Uncle Sam doesn't need to be blessed by your money, but at least you can testify, and Uncle Sam can testify that you have lived to a certain standard. So, in a nutshell, I want to leave a few minutes. I could go on and on, but these are very complicated things. I want to open it up again for a few of you that may have questions here and there for the next couple minutes, and then we go back and forth, and or even Immaculate could want to share any specific things, or some of my colleagues that are here tonight that we work together in this whole industry could add on. Please feel free to open up your mic and we just take on your questions. Thank you.
Thank you, Herbert, for that great presentation. It's always refreshing to come here and learn, it can never be enough when we learn together like this. So when we talk about those legacy building and generational wealth, people think like those are just big words, but that's where it starts. Because if we're not building now, then when? Whichever tree you plant today, those are the seeds your children and grandchildren are going to eat on. So it doesn't have to be too big. Like those words becomes like so big to the people's ears, but really the little seed you plant is going to give you something, and it's going to push your children and children's. And when it comes to protection, even before you generate those wealth for the generations to come, are you even safe today? Is your family protected? If something was to happen to you today because you're working, will your children today even live alone, your grandchildren, will they survive? Will their home be paid? So that's where we start. Thank you, actually, Herbert, for sharing. This is a time whereby people get money. They're excited to shop, to buy things, that even forget where they put the money to. But just a little percentage could actually help. Thank you. That was good.
All right. I want to see if we have any questions in the chat box if you're looking at it. Open up your mic, whoever. If you want to make any comment or have any questions, please feel free to open your mic up.
There's someone in the chat who asked, how do you set up the IoT? Who can set it up?
Or who can set it up? Okay, good. That's a very good one. So as we mentioned, the irrevocable life insurance trust. I understand, as Ima mentioned, don't be, scared by the crazy words, terminologies or jargons, if I may say, of any specific industry. So the way to approach this, the way to start off on this is, working with your agent, your life insurance agent, or, an insurance company. They have attorneys. The attorneys, usually you could start with an attorney and say, I want to set up a trust. Basically, you're starting up with a legal box. The whole point of an attorney is it has to be legal. And that legal person or legal entity is going to own your life insurance policy. So step one, you get an attorney. Two, you get a life policy. And this life policy goes to an attorney because that attorney is working with you to set up whoever you design it. Because at this point, let's say I have my wife and kids, and they say, okay, I'm going to set up a trust, and this trust is going to be owned by, whatever company or organization. And I go buy a policy for my wife or my, son. The policy is going to be owned not by me, but by the trust, because I have to say who is running that trust. But we're not going to go into the legal aspect of it. The trust is just somebody or another entity that is going to own that life insurance policy, and then you get to buy a policy. The whole idea of why you got to work on a trust, you want them to own your assets, and one of your assets is it could be a trust that owns your mortgage. And actually, a trust can own most of all these things. You put in your mortgage, you put in your asset, or not a mortgage, actually your paid house, your, whatever assets you have, including the life policy. So that should be pretty much simple about it. You're not owning it, someone else gets to own it, but that person has to be of your choice. And you could start from the lawyer's standpoint to advise you in your state, because different states have different, laws regarding these trust setups. Second question, if you can see there, okay, yeah, that was it. That was the very question that was there. Collins, go
Question,
ahead.
Mr. Hubbard. Thank you very much for the presentation. That was really insightful. And so my question is this for primarily a vehicle for high net worth individuals? Or because it sounds like this is really planning for legacy, somebody who has a paid house, 100K, just that they can borrow. Can people benefit from this if they're still in their accumulation phase, let me just call that, where you're still growing, you're still kind of
Right,
you're
that's a
focused
very
on growth more than tax
exactly.
efficiency?
I appreciate the question. Actually, that's a very good one, Collins. So, the net worth, it's a pretty interesting term. If you're looking at net worth in terms of cash at bank, my view, a simple answer, any life can be net worth at crazy millions of dollars, even though they don't have cash at bank. But when it comes to pure finance or money pieces, then you say, oh, net worth of $1 million or net worth of $300 billion. But remember, and life is invariable. Life is, you could force yourself into net worth by how you position yourself. Unless you're saying you are not able to pay, but if you're going to look at, let me say I have a mortgage of, maybe, 300,000, or I'm able to pay $300 every month. I could well do it in a trust that is to the level of my capacity. But then the trust of a 1 billion net worth guy would be, way crazy in terms of money, because it's a huge amount of money. So yes, traditionally on the marketplace, they will say, oh, no, trust is for only this and this. But that's I would say, yes, I understand. But again, I value my life to be worth those millions. So I would set up a life policy and put it in a trust regardless of the cutoff amount that the marketplace happened to mislead me on. That's how at least I would look at it, but different people have different ways of looking at life and things. Some people read stuff on the market and get scared by that and don't, go that route and think it's for another group of people. But that's why we have those agents there and those attorneys. You reach out and they advise you, say, hi, if you have this amount, let's see if you can set up a trust with that. Or once you find it working out, then you go work for that amount to be able to set up a trust, because at least in some sense, you're going to own properties. We all trying to own these properties here and there. Could be a property of 10,000 or 20,000, and someone else is doing a property of pursuing a property of millions of dollars, and they say, no, we are the ones to do the trust. You guys are not are not well, to the standards of trust yet. But yeah, that's a very good question, and the marketplace dictates, so tries to prescribe trust to certain net worth people. Or let your attorney, let your insurance agent advise you the better way, if given the amount of money that you're able to consistently pay. But at least one thing for sure I agree is that the trust is for sure meant to plan you forward, unlike the uh, traditional vehicles that uh, we're used to looking at in the marketplace as of today. I see Nema. Nema, yes, please go ahead.
Thank you
Nema,
so much for the training. It was very, very beneficial. The question that I have is, I know that when we are trying to sell the policies, one of the principles that we say when we are trying to compare investing in the markets versus owning IUL, for example, is to avoid management fees, right?
yes.
To pass probate court. And there's a long list, right? So when we're talking about this trust now, okay, it's good to have trust, yes, for your assets and stuff like that, right? But for when it's come to IUL, for example, right? If you put your insurance in that trust, meaning some of those principles or the benefits of going towards that route of getting IUL or index account instead of being on the market in the variable portfolio, it's kind of like, I feel like it's it's defeating the purpose of going that route of index, instead of being in the variable market, because you remember we have caps, right?
Mhm.
When we are putting our money into the index, right?
Mhm.
However, if you put your money in the market, if it's 20%, 34%, I mean, obviously there's ups and downs,
Right,
right?
right,
So how do you explain that now?
right. So that's a very
But
good
I'm
one.
so sorry,
So,
this is not based on
yes,
your
no,
presentation.
I really like it. Yes, and it's very, very uh, pragmatic. Let me say that it's very practical, because uh, so here's some of the investment principles. If I can take you to this slide. Uh, Different people have different risk tolerance levels.
Uh-huh.
That's one. Two, by principle, it is a bad idea to keep all your eggs in one basket.
Mhm.
Three, investments comes with risks. So if I am looking at market and interest rates with cap rates, I got not to be blind spotted and blindsided by the idea that the market is always going to be positive. Yes, it's been positive, and we wish it's always positive. So we're talking of strategies. Strategies is more than 1, 2, 3, 4. So the trust is a strategy, the market is a strategy, and the concept should not be that this beats this. No, it should be open learning. How does the trust pathway work? How does the vehicle of market rates and how do that one work? What are other pathways for investments, and how do I spread my insurance? And as agents, as advisors, this is what we should be advising our customers. Have this, have that, try to position yourself in this way if you are able. If you're not, pursue one for a time, but you can't criticize the other because they are investment vehicles, and what works for one may not work for the other. But yes, I agree with this is not IUL versus trust or trust versus no. It's a growth strategy, another growth strategy, another growth strategy. And one should find their comfort levels where they want to pursue at any given time. Does that make sense?
Yes, thank you so much. Yes, thank you. Thank you.
Thank
Mhm.
you. Awesome. Yes, should be right on top of the hour. No, actually 6 minutes past, but yeah, if you have any questions, let's not cut you off. Just go ahead and open your mic. Otherwise, I'll pass it back to our Immaculate to close it off, and until next time. All right, Ima, back to yours, because it seems like we're all good here. Thank you.
Yeah, thank you once again, Herbert. Yeah, I think the topic today was a little different from what we usually discuss, but that is why it was legacy creation and asset growth strategies. You said it beautifully. There are many strategies we can use out here. Some people can choose just to buy IULs, If you want to buy an IUL, if you want to buy a whole life, you want to buy a term life, it's a different strategy. Even the IUL itself, when you talk about IUL, the indexed universal life, which is a permanent life, itself has two different paths. You could buy accumulation IUL, the other person would buy a protection IUL. But if you call it the same, it's different. So the strategies are different depending on who is buying what and the needs they do have. So I think this was really interesting. Someone is writing something there. Justin is saying, I kind missed one important question you mentioned about trust. Justin, you want to go ahead and ask something? So that is interesting. This is a new thing, maybe. We need to be talking about more often, Herbert.
Right, that's why we should actually fasten our seatbelts with this kind of learning, because we're actually breaking into more strategies, if I may call it. But the whole point was to talk about strategies, asset growth, legacy planning. Life insurance can be a very interesting one, but if you take it to another higher level, a more traditional level, that's where we're headed to. And Justin is mentioning something around. I think Justin is thinking maybe we just talked about. Someone mentioned asked a question about a trust, but hey, Justin, the whole idea we discussed about tonight was pursuing life insurance, growing an asset around life insurance, a policy through the trust path, the irrevocable trust. I guess maybe you will, I'm sure Immaculate will share this recorded video tonight. I will share it tomorrow. You can go back from the start to get the whole point in the information shared on the slides. But you didn't miss much. Did you say anything about attorney? Yes, we said that attorneys if you're going to build a trust, you work with life insurance agents and attorneys, yes, to be sure you are relevant to your state laws. All right, Emer, I appreciate you and I appreciate everyone's attendance tonight. Again, thank you, and I look forward to coming back sometime.
Thank you again, everyone. Again, same time, same link. If we have a link from tonight, that is the same link we do use every Thursday. We do tackle different topics. As you can see, this one was very, very interesting. Maybe Herbert will come back to talk more about the trust and how you can actually set them. It's not about just life insurance. You can set trust again, as he said, for different assets. So this is good to learn. So we can always compare those assets and wills and everything. So those are our topic. Actually, this session of ours is financial literacy and money matters. And financial literacy goes beyond life insurance. So as you can imagine, that is a broad discussion that we do have. That is why the last time we had people from real estate. How do you actually plan if you're planning to buy a home? How do you do that? If you actually, this is a tax season. If you're planning to buy a home, what do you do now to prepare for the year to come or next year, 2 years to come? So this financial literacy is broad. So you don't want to miss, because next week, it might be something even more interesting. So thank you so much again for joining tonight. Look out for the recording for those who came a little late. I'll see you again next week, same time, same hour. Have a good night, everyone.
Thank you.